Hey everyone, I'm back to answer a question I get asked a lot. What is angel investing? It's really simple. Angel investing 101 is you are a startup. I am a high net worth individual, accredited investor. Google what that means, $200,000, $1 million plus net worth, blah, blah, blah. And I give you money and I buy a percentage of your company. Generally, it's at friends, family, and fools, the earliest round, then angels, then pre-seed and seed. This is where I consider angel investing to be. You can do later stage, series A or B, but that's not really angel investing. And the average check is about $25,000. So we've made about 60 investments into early pre-seed, seed startups at less than a 10 million valuation. That's the other caveat when it comes to investing is I consider you a professional angel investor, not only when you make an investment. Writing checks is easy. You want to find a startup, a founder to write a check in, I have hundreds for you. But a professional angel investor is someone who takes this seriously. You do diligence, you have an expertise, you can add value, your network of other investors to raise capital, go to market, strategy, hiring, business development, all great value adds. But why do we invest? To make money. If I invest in your startup, I'm looking to get back minimum 10 to 20 times my investment back. If I give you a check and buy a piece of your company early on, and I'm only expecting 2, 3, 5 times my money back, that's not angel investing. That is just a normal investment. That is private equity. That would be amazing returns for a hedge fund. But I want 100 times my money back. That is really what your expectation should be. And that's what VCs expect as well. Every investment you make, if you are a professional angel or a venture capitalist, should theoretically return your fund. If you have a $10 million fund, you make a $100,000 investment, you need 100x just to return the fund. Yes, there's dilution and other issues, but every single angel check you invest should expect to make you a lot of money. Now, early on, you can get into the semantics. If it is a priced round, you actually buy equity. If it's a safe standard agreement for future equity, you don't technically own equity until the next round. There's debt, convertible debt. It's not equity. It will convert. It is debt, as it says. You will convert into the next round. So also remember, as an angel investor, my job is to make a lot of money, but interesting times, I consider myself a scout. I not only try and invest in the best founders, the best ideas, the best companies if they have traction, I need to also invest in companies that can raise additional capital. That's kind of the little nuance that you'll get a gut feeling over the 10, 15 years I've been doing this as a founder, operator, and investor. Not only do I have to find these cool companies, not even cool, some of them are really boring. And that's perfectly fine. You don't have to be the cool hot, hey, we're doing AI, sprinkle, big data. I just want a company that can be acquired. I am in the investment business. That's what most people think, but actually I'm in the exit business. I only make money when you get acquired or IPO, which these days is very difficult and companies were overvalued and there's stacks, lots of issues going on. So I digress back to the initial point. A professional angel investor, which I consider myself because I've been doing this for 10, 15 years and have a portfolio of 60 companies, is I meet a founder, they pitch me, they tell me their story, they tell me their product, their traction, hopefully what their team can accomplish, and me, hopefully having some knowledge of the industry. I'm not an expert by any means, but I sometimes know just enough to be dangerous, or I know the right people. And I say, okay, mental gymnastics, XYZ, carry to 1, divide by 2. This could actually make a lot of money if it works out. It's a lot of ifs. Oh, and if they hit the numbers that they're pitching me, my friends who I've spent all my career meeting at this next stage of the seed and series A, in 12 to 18 months, will they think this is interesting? And has the team achieved the goals that they need to raise additional capital? How much capital? What's the valuation? Did you raise a too high a valuation? Are you going to need a bridge? Basically an extra amount of time because you couldn't achieve for whatever reason. Why? Half your revenue, double your expenses. That's what we tell founders. Keep your burn low, founder-led sales. So, angel investing, really easy. I want to invest. Okay, here are the terms. I'm raising $500,000 on a $5 million valuation. Great. When this is done and the wires are signed, all the investors will own 10% of your company. The founders, assume there are two, they were 50-50. Now they're 45-45. We'll have an ESOP, an employee stock option pool, usually 10%. They'll be down to 80%, which is fine. 80% of 5 million isn't too bad. And as you grow, you'll have a smaller piece of a larger pie. So as an angel, I know I'm going to get diluted. So if I invest at a 10 million valuation and the company exit for $1 billion, wow, that is 100x. Not really, because that was the seed. Then they went on to raise an A, probably another 20% dilution. Maybe a B and a C, each of which are another 10 to 30% dilution. So by the time I get from the 10 million to the 1 billion exit, I've probably already been diluted by 40 to 60%, depending on what their strength and everything that they've been able to do is. So that 100x actually is maybe closer to a 25 to 40x. Still not angry. That's a great return, but I still need 100x. This is why we got crazy when it came to valuations. The difference between a 1 billion and 5 billion exit, I know billions is a lot of numbers, and 1, 2, 3, 4, 5 is a huge difference. Imagine my 20x getting a 5x from 1 billion to 5 billion. That's huge. That goes from a 20x to a 100x, but it only went from 1 to 5. So once you start getting to bigger numbers, the multiples really jump, which is why everyone got crazy with unicorns, because the numbers get pretty astronomical. But don't get ahead of yourself. Don't give in to FOMO. If a deal seems too good to be true, it probably is. And if someone says that they can guarantee you a return, just walk away. The best thing about this industry is there's no shortage of founders, no shortage of startup ideas, and there will always be another deal. So take your time, don't FOMO, and really try to only invest in the big ideas. I think over the last few years, we got away from that. So if you have any questions, let me know. I'm around. Thanks.